Welcome folks to episode 9 of ICT's 2024 mentorship. So this is my understanding of after watching that specific video. I hope that it will help you to understand a lot because this is gonna be the most important video I have ever made. Before starting this video, I really would love to request you to give me the thumbs up and subscribe to my channel if you are new. So if you ask me, brother, what is the video or which video you will suggest me to watch to understand ICT concepts? I will tell you that, brother, this is the video. This is that video which you have to watch and you have to understand perfectly to be the wizard of this market. Now, why is that? I will give you this answer at the end of this video. But if you don't watch this video until the end, I promise you, brother, you won't understand anything why I told that. This is a very little suspense. Okay. Over here, this is the new day opening gap, and we had a news around 8:30. What do you see? Market came here exactly to that new day opening gap, then went higher. Okay. After coming here around that area, oh, by the way, on my left this is S&P 500, on my right this is Nasdaq. Why I opened that S&P 500, I will talk about that later. In this video, I will talk about this as well because I need to clear something about the SMT, smart money technique. Okay. So over here, market has traded that new day opening gap, went through this new week opening gap, then it has made this high. So that is the primarily buy side liquidity over there. That is the buy side liquidity just before the 9:30 bell, opening bell. Okay, over there. Now, if you see, this is the 9:30. Before the 9:30 opening bell, this is the buy side liquidity. Below here, market has made this relatively equal lows. So if you see from this low and those lows, they are relatively equal lows over there just before 9:30. This is the sell side liquidity, and below this sell side liquidity you have a fair value gap or something like that. If you look over here in S&P, it is that specific buy side, that swing high, and this is the swing high. They are the same. And below here you have some relatively equal lows and also this fair value gap. It is not important over here. I just added this chart just to show you the SMT, when you should look for the SMT. So let me actually clear that first. When market has taken this buy side liquidity, okay, around 9:32. So if you look over here around 9:32, market has taken the same buy side liquidity around that area. Okay, so 9:32, market has taken that same high, swing high. It has been taken over there. When market has taken that one, and E-mini Nasdaq has also taken that buy side liquidity, there is no SMT, right? Just no SMT. After, if you take a closer look around that high, the next high, okay, over here, which has created around 9:37. So I would love to mark that swing high as well. This is that swing high which has created in S&P around 9:37. And if you look over here around 9:37, this is that 9:37, okay. This is that same swing high it has created over there around 9:37. This is that same swing high, and I'm going to mark it, extend it to my right. After taking this buy side liquidity, ICT was looking for that sell side liquidity. Not only ICT, I was also looking for that sell side liquidity. Why we are looking for that sell side liquidity? The reason is we have a opening gap, a big opening gap. We have this relatively equal lows. After taking that buy side liquidity, market should take that sell side liquidity, at least this sell side liquidity, even if it wants to go higher. That is why we were looking for that sell side liquidity. Me and ICT, both of us, were looking for that one. I would love to get rid of this chart. That's why I would love to finish the SMT part first. Okay. Now, when it has been shifted that high, look at this candle, specifically that candle, when 9:58. Okay, look over here on my on the bottom. Around 9:58, market has went through that high. Now, this high, when market went through that 9:40, then here 9:47. So this candle has shifted that high around 9:58. Let's see where is 9:58. So there is 9:58. Okay, this is that candle. In that specific time, market already left lot of area. So from there to there, it has went over there. Now maybe you are looking for the market. So you are here and here. Okay. So same time when you saw this is the SMT, because in mini S&P market didn't take that high, but in Nasdaq market has already taken that simple high, okay, that same high around 9:37. This high has created 9:37. This high has created 9:37. It has taken that that high, but it didn't take that high. So that is your SMT. For example, maybe you are seeing this way, and over here you are seeing like that way. Okay, that way. You are seeing this is the SMT. Whenever you will see this SMT and you will start to think that now market is going to fall because you are expecting market is going to toward that sell side liquidity. So you will try to take a sell over there. No, you can't do that. This is not the every rule, but this is a rule ICT has explained in this specific episode, which is important to understand. This is one rule out of maybe another 20 rule of SMT. That is why I keep telling SMT is too difficult to understand. Don't just go and watch other people who are saying this is the SMT, so let's look for sell. No, SMT is not like that. When you got this SMT and you saw that even S&P failed to take that high, you will start to think that this Nasdaq will fall. It will fall dramatically and it will go below some kind of PDRA. That PDRA is holding the price. Any kind of PDRA, it will go through that PDRA, it will fall, and at the same time it will much go lower. This guy will go much more lower. If you see this and if it can break some kind of PDRA, for example, maybe there is a fair value gap. So just for example, okay, I'm just not I don't want to mark any specific thing as there is market never fall actually. So I didn't want to mark any specific thing, but just for example, there was that fair value gap, that is the period. So what it has to do, how you should look for the trade. First, it has to go through some kind of bullish period. When it will go through that bullish period, then and only then you will start to look for sell. Even if there is a sell setup, you are not going to take that sell. You have to wait for that type of situation to use the SMT. Okay, I hope that it is little understandable for you guys. But either way, that is not my intention to talk about that SMT by this episode, because I also didn't talk about that. I just wanted to get rid of that elimination picture. That's why I actually used this one. So let's talk about the price action. This is the 9:30 opening bell. Okay, this is that 9:30 opening bell. What is my expectation first? That market will take that high, relatively equal highs, this high and that high. They are relatively equal highs. Market will take that relatively equal highs, then it will go to take that relatively equal lows, this low and that low. They are relatively equal lows. So market will take that relatively equal lows. That should be my expectation. Now, if you take a closer look over here, I have a very nice bullish parabolic gap around that area. This is a very nice bullish parabolic gap. My expectation is market will go for that sell side liquidity. When it has taken that high around that area, when this high is taken, market went lower. I would love to see that market will stay below this gap, below this parabolic gap, and then it will use that parabolic gap as an inversion parabolic gap. Then it will take that sell side liquidity. What happened? This time market came lower that parabolic gap, make a fake breakout, go back again, closed above this parabolic gap, never go back again below this parabolic gap. That means you are not going to take sell. You are not going to force the market to give you the sell setup. Here we had this breaker block around that area, low, high, lower, low. I was in live. I was doing the live streaming. ICT was in live streaming as well. I told in my live that I know ICT is talking about that breaker block. I have already tweeted that to my Twitter, that clip. You can watch it and check it, okay? This is how I am building my kingdom. I'm not against ICT, okay? I'm the most beautiful student of ICT, but he doesn't know me, whatever. So when market went higher and take that high, look over here. This high has been taken one more time. If it wants to go higher, it should not come back again to this parabolic gap. This is the rule. Okay, I have in ICT's video, ICT the way ICT explained, I'm just explaining it the same way. Though I'm expecting that market will go for that sell side liquidity, but when it has taken this buy side liquidity here, right? Then market went, then go back again, took that high. Then next high, market has taken that high as well. When it has taken that high, it should not reach until this parabolic gap one more time if it wants to keep going higher. As I'm looking for sell, I'm not looking for buy. I don't care what is happening over there. I don't care. So I am looking for sell. What I should expect, that I am expecting market will go through this parabolic gap, then it will tap to this parabolic gap and it will go for that sell side liquidity. Also the opening gap, everything is over there. I didn't mark the opening gap. You can mark it by going the regular trading hour. So you can see this is the opening gap. It's a huge opening gap. Okay, so from there to there, this is the opening gap. So you should think that market will go back again into this opening gap, and then there is the sell side liquidity that should be triggered after taking the buy side liquidity. At the same time, you have to understand the fact over here, if market would love to keep going higher, it should not come back again to that specific fair value gap. Then market went higher around that area, and finally market reached over there. If you go to your weekly chart, you will see there is a weak 50%, weekly weak 50%. Okay, market trade over there, then started to fall. When it started to fall, what should you expect? That market is going for that sell side liquidity. That should be your expectation. Yeah, market was overzealous, so market went too far, maybe to trade some kind of higher time frame PDRA. So after trading that higher time frame PDRA, you should start to expect that market is reaching for that sell side liquidity. Okay, so when it is falling, are you going to take sell? No, you have to wait for the price action. How should you expect for the price action? First, look at this fair value gap. Okay, over here, this is the fair value gap. You should expect that it is going to work as an inversion fair value gap. Okay, so let me mark it as an inversion fair value gap over here. This is going to work as an inversion fair value gap. What do we mean by that? It will go through this fair value gap, it will trade that fair value gap, then it will go and it will keep falling maybe until this sell side liquidity. There is some sell side liquidity here, maybe there is some kind of breaker block or something, whatever it is, but it will keep falling. This is how you should expect this inversion fair value gap is going to work. At the same time, are you going to push your button because this candle has closed below this fair value gap? Are you going to push your button over there? No. Why you are not doing that? Because you have this fair value gap over there and that fair value gap over there. Okay, so let me mark both of the fair value gap. This fair value gap should not be traded. If market keep falling, wants to keep falling, this should not be traded. Okay. At the same time, look at this fair value gap. Okay, let me actually change the color so that it will be easier for you to understand. You should expect that market will trade the lower portion of this fair value gap, not the upper portion. Yeah, body can touch the consonant crossment of that specific fair value gap. Obviously, body can trade the lower portion, that means the 50% of that fair value gap. Then it should keep falling and it should close below this fair value gap. It will trade that below lower part of this inversion fair value gap and it will go lower. When market went lower, it has made this weak. Look at this weak. When you are observing the price and you are thinking that market will fall, first what it has to do, it has to break that consonant crossment. That means a body should close below this 50% of that specific week. All of these things should be happen if you would love to take a sell. Until getting the confirmation, you can't look for the sell. So after watching ICT's video, some of you maybe thought that okay, ICT is wrong over there, or maybe I took that sell and it was a losing trade. Why did you take that sell? You should not take that sell, because what you should think, first you are thinking that market is going to go for that sell side liquidity. That should be your first thinking. You can't think that market is going higher. You can't think that like that way. Why? Because market left some unfinished business over there. So that should be your first thinking. Now when you got a situation, this is a situation market has made where you started to think that maybe market is going to fall, but that doesn't mean you are going to push your button. For pushing your button, market has to meet some specific requirement. What is the first requirement? The first requirement is body should not close above the consonant crossment of that specific inversion fair value gap. That should be the first requirement. Yeah, obviously price can trade until lot of time, okay, a lot of area it can trade, but body has to close below the consonant crossment of that inversion fair value gap. That should be your first requirement. The second requirement is market should not trade the upper portion of this specific fair value gap. That should be the second requirement. And if it doesn't trade that upper portion, obviously there is no question to trade that fair value gap, right? There is no question to trade that fair value gap. What is the third requirement? Has to close below this 50%, below this week 50%. See this week 50%, that is the discount week. It has to close below this week 50%. Now, if you see everything is in line. So, for example, first market fall, then it came until the consonant crossment, then it fall again and closed below this week 50%. Then you are ready to push your button. you will start to look for an entry opportunity after seeing this. That is the confirmation that no, market is now falling. Maybe for this sell liquidity, maybe for some kind of low hanging fruit, for whatever it is. But after that, you will be able to push your button. Until then, if you push your button, that means you are forcing market to give you the entry. Please don't do that. Okay. Then when market actually failed to see this inversion fair value gap, this inversion fair value gap failed and price has traded that specific fair value gap that should not be touched. Okay, though market can close, trade until the high of this specific fair value gap. Sometimes it happens. Okay, but it should not touch that fair value gap. Whenever it touches that last fair value gap, okay, what ICT started to think that market is going to take that buy side liquidity. That is the new buy side liquidity. So even if market would love to fall, it will fall after taking that buy side liquidity. So in that type of situation, when it touches that area, see this last fair value gap, when this candle has touched that last fair value gap, immediately ICT has marked that as an inversion fair value gap. So over here, this is his new inversion fair value gap. I'm going to remove this last fair value gap because it has done it. So when it can tap over that inversion fair value gap, this should be your entry opportunity. Until what? Until this buy side liquidity. Okay. Here is the part, you are not going to take that buy. Why? Because you know that market should fall until this sell side liquidity. This is the reason at the beginning I told this is gonna be the most important video to watch, because when you are expecting market is going to fall, for example, you are expecting that market is going to fall, every kind of buy setup you will let them go. You are not going to participate in that price action. If you do that, that means you are a gambler. You are gambling. You are trying to put one more coin to the casino box. So you can get the jackpot, something like that. Don't do that. You are looking for a sell setup. You didn't get that sell setup. Stay sideline. Outline this buy entry, but don't push your button over there. If you can understand this small logic of this concept, trust me brother, you will be the wizard of this market, I promise you. Most of the people don't understand this small logic. They think, okay, maybe I'm wrong, maybe market is not going for that sell side liquidity. Obviously you have to understand why market is going to fall for that sell side liquidity. You have to understand that part. Okay, when you are looking for that sell side liquidity and you are getting the buy setup, okay, over here you have the buy setup from that fair value gap, you have the buy setup from that breaker block, then you have the buy setup somehow here also some buy setup, that inversion fair value gap buy setup. All of this buy setup you are going to outline, but you are not going to push your button over there. This is the small logic. If you can understand this logic, you will be the wizard of this market. So that was the information, or that was the message by this video I wanted to share with you guys. If you can get that message, don't forget to let me know in the comment box. So until the next video, cheers.